Hello everyone, welcome to Finance Focus. For many years, investors followed a simple rule. It was called the 60-40 portfolio. The idea was to put 60% of your money in stocks. The other 40% went into bonds. This mix was supposed to deliver growth from stocks and safety from bonds. When stocks did well, the portfolio grew. When stocks fell, the bonds were expected to hold their value or even rise. This smoothed out the journey for the investor. It was a dependable strategy for a long time. It made sense in the world we used to live in. But the world changes. The financial markets of today are not the same as those of the past. We are living in a time of greater uncertainty. We see higher volatility, which means prices swing more wildly. To understand the 60-40 portfolio, you must first understand a concept called correlation. Correlation is simply a measure of how two things move together. Imagine two rowers in a boat. If they row in perfect sync, their oars move together. We would say they have a high positive correlation. If one rower pushes forward while the other pulls back, they are moving in opposite directions. This would be a negative correlation. If their movements have no relationship at all, they have zero correlation. The success of the 60-40 mix depends heavily on this idea. For many years, stocks and bonds had a low correlation. They were often negatively correlated. When the stock market went down, investors often sought the safety of government bonds. This buying pressure would push bond prices up. The rise in the bond portion would help offset losses from stocks. This negative correlation acted as a natural hedge. It created a smoother, more predictable path for growing wealth. But this relationship is not a law of nature. It is not permanent. Correlation can and does change over time. It is influenced by growth, inflation, and the actions of central banks. The correlation between stocks and bonds is not stable. It changes most during a crisis. In periods of market panic, fear takes over. When investors are scared, they sell whatever they can. They are not thinking about long-term value or strategic allocation. Their goal is cash. This is called a risk-off event. In these events, stocks can fall, and some bonds can fall too. Correlation spikes. Like a crowded theater when someone yells fire, people rush the exits at once, creating a bottleneck. Large funds sell assets to meet redemptions, risky stocks and stable bonds alike. Coordinated selling pushes both asset classes down. Diversification benefits evaporate when needed most. For decades, crises meant lower rates, a tailwind for bonds. But what if they can't cut further? Or inflation is the problem? In inflationary episodes, banks must raise rates. Rising rates are bad for bond prices. If higher rates also spark recession fears, stocks can fall too. Negative correlation flips to positive. In 2022, aggressive hikes to fight soaring inflation drove significant losses in both stocks and bonds. The 60-40 had one of its worst years in decades. Beyond correlation, volatility matters. Volatility is how much prices swing. Low volatility is like a calm sea. High volatility is a storm with large, unpredictable waves. Many models assume moderate swings. They are not prepared for extremes. High volatility raises the chance of sharp losses. The 60-40 can be surprisingly vulnerable. Another hidden risk is liquidity. How easily you can sell without moving price. Cash is perfectly liquid. A house is not. In crisis, liquidity can vanish. Buyers disappear. Remaining bids are much lower. This is a liquidity crunch. When everyone heads for the same door, it narrows fast. Even safe bonds can become hard to sell, forcing steep discounts. Crowded trades happen when too many investors do the same thing. The 60-40 became crowded. Popular strategies create their own risks. If everyone sells at once, pressure is immense. We saw it in crowded tech trades and on the bond side with long duration. The idea that stocks and bonds can fall together is not new. In 2022, inflation surged to multi-decade highs. The Fed and other central banks embarked on one of the most aggressive hiking cycles in history. Bond prices were hit directly. At the same time, recession fears sent stocks tumbling. Both sides of the 60-40 suffered heavy losses. Look further back to the 1970s, great inflation, energy shocks and expansive spending fueled persistent inflation. Bonds struggled as fixed payments lost value and prices fell. Stocks also struggled as costs rose and profits sagged. For much of that decade, 60-40 failed to provide growth or safety. Tail risks, unlikely but massive events, occur more often than models suggest. In 2008, many assets fell together in a dash for cash. Normal diversification can break down in extremes, leaving portfolios exposed to severe losses. The challenges facing the 60-40 portfolio today are unique and significant. After 2008, near-zero rates and quantitative easing created long tailwinds for stocks and bonds. 60-40 thrived. However, that era is now over. We have shifted from low inflation and falling rates to higher inflation and rising rates, a fundamental change. Central banks can no longer cut at every stumble. Their mandate is to control inflation, largely by raising rates. That is a direct headwind for both stocks and bonds, the exact setup where 60-40 can fail. High debt loads across governments, corporations, and households make economies more sensitive to rate changes. Small increases can have outsized impact. Tighten too much and risk recession. Too little and inflation runs hot. Both are bad for 60-40. New geopolitical risks and disrupted supply chains add uncertainty and inflationary pressure, increasing market volatility. In a fragmented, unpredictable world, a fixed 60-40 allocation looks increasingly inadequate for managing risk. If the traditional 60-40 is facing new challenges, what should an investor do? Do not abandon diversification. Think more broadly and intelligently. There is no single magic formula. Aim to build a more resilient portfolio. Look beyond just stocks and bonds. Seek assets with genuine low correlation, especially under stress. Real assets can behave differently. Real estate, infrastructure, gold, and commodities may help, particularly in inflationary periods. Certain alternatives, market-neutral and managed futures, can diversify across regimes, though they require careful research. Be more dynamic with risk. When volatility and correlations rise, reduce equities, raise cash, and very short-term bonds. When conditions calm, add risk back. Rules and discipline are key. Reconsider bonds. Diversify within bonds. Government, high-quality corporates, and inflation-protected bonds like TIPS. Manage duration. Shorter maturities can help when rates rise. A thoughtfully constructed bond mix can provide more stability than a single broad index fund. Moving beyond a simple 60-40 rule does not have to be complicated. Take deliberate steps to make your portfolio more robust. First, define your goals and time horizon. 30 years to retire or 3 years to buy a home. Your horizon determines appropriate risk. Second, stress test your portfolio. Ask, what if stocks fall 20% and bonds 5% simultaneously? A simple spreadsheet turns abstract risk into concrete numbers. Third, add true diversifiers. Start small. 5 or 10% to gold, commodities, or REITs. Choose assets likely to behave differently in the scenarios you fear most. Be mindful of cost and complexity. Fourth, set rules for rebalancing and cash. Consider wider bands to avoid forced trades in crises. Maintain a healthy cash reserve to avoid becoming a forced seller. Cash provides options, and optionality is invaluable in uncertainty. The classic 60-40 has served investors well. Its logic is simple and appealing. It assumes bonds reliably counterbalance stock volatility. But the landscape has changed. Higher inflation, shifting policies, rising correlations. The old rules may no longer apply as reliably. 60-40's downside protection can no longer be taken for granted. Diversification is not dead. It is more important than ever, but it must be more sophisticated. Relying on a single static rule is hope, not strategy. A true strategy means understanding risks and taking steps to mitigate them. Look beyond stocks and bonds and be responsive to change. Prepare. Don't panic. Do not try to predict perfectly. Build resilience. Stress test holdings. Add true diversifiers. Manage risk intelligently. And keep your goals front and center. The world is uncertain. Your portfolio should reflect that. Those who prepare for difficult weather are most likely to reach their destination safely. Thanks for watching, and don't forget to subscribe for more amazing videos.